please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Gains intact, and it's up in a way for the benchmark indices and the mid caps and the Nifty Bank, no matter which index you're looking at. Well, speaking of banks, it is a big morning for the financial sector today, thanks to the news that we've got from Moody. So great time to be welcoming in Suresh Ganapathy, banking analyst at Macquarie Securities. Of course, he's joining us from the sidelines of the conference that they are hosting. Suresh, good morning. Thank you so much for taking out the time and being with us. First things first, I mean, what we are hearing from the morning is this reducing cost of capital that's probably bound to happen because of the sovereign upgrade that we've got. How do you cut it down to what it will mean for, companies and the cost of credit?
Yeah, so it will take some time for it to flow into the system. The immediate impact could be on very well-rated corporates. The corporates which obviously are under the NCLT or where some resolution of bad debts is happening, I don't think so this is going to move the needle in a big way. So the credit cost environment for banks will still continue to remain pretty challenging. It's the well-rated corporates where very clearly there could be some visible impact, and in fact that could create a base for a lower margin structure for banks, because remember that these well-rated corporates can really bargain very well and get a lower interest rate on their borrowings. So to some extent near term could be negative, but over the longer term all these rating upgrades should be construed as positive for the banking system.
Okay, good morning, Suresh. Well, actually, the financials are the ones that are leading the pack, as Surabhi just said. What changes for the financials?
Well, to begin with, Lata, if you look at it, 90 to 95% of the funding for banks in India happens through deposits, and that has no correlation with any rating upgrade, right? So one has to understand that this is not going to flow into bank margins immediately in any possible way. What could happen is over the longer term, clearly because of the positive sentiment and the rating upgrade, cost of capital for the system will come down and it could have an eventual impact on credit cost. But as I said, if you're going to see an earnings upgrade in FY18 and 19 because of this rating upgrade, certainly the answer is no.
Okay. Suresh, good morning. You know, the other issue which has been interesting is that over the last 1 month, we have seen a lot of these corporate-facing banks rally, while we had seen some consolidation, profit-taking in the retail-focused stocks. Do you think that trade has played out, and is it back to get into the stronger balance sheet, the stronger banking stocks?
Well, Anuj, to a great extent, it would all really depend upon how the recap bonds framework is, because at the end of the day, that has implications for fiscal deficit, market rates, and also remember that the government has been continuously talking about structural reforms accompanying this recap bonds issuance for all these public sector banks. So those will be the triggers for the further rally in some of these corporate-facing banks. In case those reforms are not as per expectations, clearly we could see some downside in some of these names. So it's all a function of how well the government is in a position to implement some of these reforms that they are talking about to accompany the recap bonds.
Suresh, in the last 24 hours, another development that's happened is, of course, the definition of affordable housing and that, carpet area, square feet increase. Does that materially alter your earnings expectations, return expectations from housing finance companies?
I mean, it will take some time, because remember that for the affordable housing to move the needle in a very big way in terms of growth or margins or profitability will take time, unless and until it becomes a very meaningful proportion of the portfolio for all housing finance companies. Nevertheless, that's one sector where the demand has been quite secular, and the government has also been in a position of trying to improve the supply side response when it comes to affordable housing by giving them more incentives to the builders. So net-net, we still remain pretty constructive on housing finance companies, because that's one sector where I said growth is going to be secular, and most of them are very well rated, so if this rating upgrade of course is going to play through well, some of these housing finance companies can continue to borrow at a much cheaper rate and therefore be very competitive in the home loans category. So it's pretty positive for all these players who are there in the affordable housing segment.
Just now K.K. Mistry told us the way the carpet area has been upgraded, it has now become 150 square meters. So it's something like 1600 square feet houses that now come under the subvention scheme, Suresh. the potential, increasing this to the subvention limit, does it have the potential to become an engine for growth itself?
No, so Lata, you have to understand that though you're talking about the credit-linked subsidy scheme,
exactly.
right, the CLSS of
exactly.
the government. Yeah.
Yes.
Now, that comes with a lot of conditions that
yes.
people miss. So if you look at the finer print, what it clearly says is that suppose I have a 1 BHK and I want to go to a 2 BHK, I'm not allowed. The first house that I'm going to buy is what is going to be eligible. So, you are actually potentially taking away a large portion of the market for all those people who want an upgrade from a 1 BHK to a 2 or a 3 BHK, right? So it has to be a completely new house. Secondly, people just don't understand that in the finer prints, there are conditions on location. So if I want to buy in some place in Timbuktu in India, you can't go and buy because the government has actually specified which locations are eligible. So there are many cases when we did our channel check, we realized that many cases are being rejected by the NHP because it doesn't fall under the location list provided by the government of India. So what we are only seeing is the broader print saying that the square feet has increased and stuff. But what about the location? What about the fact that you cannot buy a house if you already own a house? So you have to factor all these things into account before actually projecting a very healthy growth rate for all these companies.
Oh, thank you for pointing that out because it did look like a big thing yesterday when the announcement came.
Yeah.
Suresh, finally, how does this reorder your hierarchy of, say, companies or subsectors within the broad financial gamut?
Yeah, so, so what we have been advocating is that, yes, at the margin, maybe on a relative basis, the trade may shift towards from high-quality banks like HDFC Bank or IndusInd or Kotak to a more corporate-facing banks. But we have been continuously advocating that if you want to play the so-called reform story and the recapitalization story in banks, it's better to play through corporate-facing private sector banks like Axis and ICICI, which are equally leveraged, to be honest, to the recovery in the economic cycle or perhaps the capex cycle. More importantly, they will also benefit the resolutions which can now happen considering that the public sector banks are in a better position to take write-offs. So these guys will also benefit, and more importantly, Axis does raise money. ICICI doesn't require money. So their capital position is far more comfortable compared to any of the public sector banks whom we believe are only getting money for write-offs but not necessarily for growth. So ICICI and Axis would be a better way to play the sector than to be honest, any of the other PSU banks.
Okay. On PSUs, Suresh, a call on State Bank of India, and also just, the point that you were making about cost of capital for highly rated NBFCs. Just want to understand that. This bond yield going up to 7.06, of course, that might be a thing of the past with the ratings upgrade now. But the way CP rates are moving, etc., are all of those concerns behind us? How generally the cost of money in the short term, interim term, was looking steeper?
No, that could still remain pretty challenging because I think if you look at it in the near term, obviously there is a positive reaction in the bond markets to this rating upgrade. But that's done and dusted because over the course of next 6 to 12 months, it's all going to be a function of the fiscal deficit compulsions. If I'm not wrong, the FM in one of the conferences yesterday went ahead and made a statement that the glide path to fiscal deficit could be possibly compromised next year. So because of the high government spending or whatever could be the reason, right? So if that exactly happens, then the longer term dynamics will be governing or whatever could be the reason, right? So if that exactly happens, then the longer term dynamics will be governed more by the structural issues to the fiscal deficit in case they deviate from the glide path. And of course, oil prices have remained high, inflation has surprised on the upside. So you could possibly see RBI taking a longer pause on rates, to be honest, instead of actually having an expectation of a rate cut. All these factors will really determine the longer term outlook for bond yield, which in my opinion at this point in time is not necessarily pretty great. So to that extent, the NBFCs will definitely have a risk of rising bond yields and therefore having a pressure on margins.
Okay.